Fed just cut rates and mortgage rates went up. All right, first and foremost, let's talk about why mortgage rates often go down before a Fed cut. When markets expect the Fed to cut its federal funds rate, or when the market anticipates easier monetary policy, you can see mortgage rates drop in advance. Here's why. First thing is anticipation and how they kind of price things in. Investors in the bond market begin to price in lower future short-term rates. So shorter-term rates, they're expecting them to be lower. And since long-term mortgage rates are influenced by long-term yields, the anticipation can cause the yields and thus mortgage rates to fall ahead of the actual cut. It's been very consistent over time. Mortgage markets, I've been saying a lot that they are very forward-looking. If they feel like rates are going to go, they're going to be raising rates, they will typically price that in early. It's all about pricing it in early. It's the same thing if you thought if a stock was going to be going higher, you'd buy into it, right? That's kind of what's going on. Bad analogy. You see, mortgage rates are tied to longer term bonds, 10-year treasuries and other related mortgage-backed securities, than to that overnight Fed funds rate, which gets adjusted by the Fed. Markets expect weaker economic growth or lower inflation after a cut. Investors are demanding, less of a yield on the long-term bonds, so the bonds fall. Mortgage rates can fall. In the run-up to a cut, if the mood is, we're going to think that the Fed is going to cut, and that signals further slower growth or inflation, then the yields are going to fall and mortgage rates fall. This is what we saw into this previous round of cuts. Now, let's talk about why rates really go down, which is the priced in dynamics. The markets had already priced in 3 cuts. So here we are today at cut number 2. The second thing I want to talk about is why mortgage rates often get worse after a Fed cut. So once the Fed actually cuts, mortgage rates don't always go down. And most of the time they go up. So let's look at why. First of all, the cut signals something else. It's inflationary, policy uncertainty. See, a rate cut by the Fed can signal that the economy is weaker than we thought, or that inflation may still be persistent and the Fed has to act. Also, if the Fed doesn't clearly signal that this cut is a part of a longer series of cuts, markets may start to reset and start pushing yields higher. Secondly, the Fed comments. If the Fed cuts, but they say the future easing is not guaranteed, this would be called a hawkish cut. This is exactly what happened today, and I'll get more into that in a second. So investors are looking at this and they really don't like those comments, especially if the markets have already priced in 3, like we have. And in today's case, the Fed cut, but Chair Jerome Powell, he emphasized that monetary policy was not a foregone conclusion. So he really shocked the markets, basically digging his heels in the ground and saying, again, we're in cut 2, the market's expecting 3 cuts. So the message he was sending is, we cut now, but we're not committed to more cuts. And inflation remains a concern. So then investors would then ask, well, what's the risk of inflation? Or what's the risk of cuts in the future? Maybe yields should be higher, so mortgage rates go up. But let's get to what happened today. Why the mortgage markets are down pretty sharply after the Fed cut. Now, today, as of close of business on 29 October, the mortgage markets are down 33 basis points. And that really just means it's a pretty large move after the Fed having supposedly cut rates. And everybody thinks, the Fed cut the rates 0.25%, and then rates got worse. It's really, really weird. But let's tie all this together with today's facts. A Federal Reserve cut, and when they cut its targets rate. And that was done today. It's a supportive move. But Chair Powell today emphasized that future cuts are not assured. He went to great lengths to say that, and that we were far from it. It was not a foregone conclusion, basically shocking the markets. Now, markets had expected 3 cuts, 1 more cut at least, and when the Fed signals that not a foregone conclusion thing, the market reset. It reset it. Basically, That whole priced in another cut, gone. What happened? Yields up, mortgage rates up. And with yields up, mortgage-backed securities lose value. So fixed rate mortgages become more expensive. That's kind of the dynamic in it all. So in summary, the mortgage market is down 33 basis points. In other words, it got worse, about 3/8 of a point for the same rate, and some of the lower rates even got much, much worse. And this is because the bond market front ran this cut. They fronted, it's kind of like fronting all the money, right? They kind of expected in anticipation all these cuts coming in. And now with these comments from Mr. Powell, they reset it and repriced higher based on the Fed's hawkish tone and signaling. So our headline is, we got the cut, but we didn't get the sustained easing the market thought. And the Fed signaled caution, yields jumped, mortgage rates got worse. Now is a great time to buy. You want to buy when there's blood in the streets. And that's what's happening right now. You should not wait. Proof in point. Be glad you're locked in if you did. Well, this is Rick. Thanks for listening to this long video. I hope to be helping you soon with any mortgage needs. Thanks. Have a great day.